Welcome back to part 2. Now that you know stocks, bonds, and Forex, let's unlock the high-octane world of digital assets, leverage, and how big money rotates between them all. Let's demystify crypto first. Cryptocurrencies like Bitcoin are digital, decentralized assets. They operate on public ledger blockchains, completely free from central bank control.
Why do people trade crypto? Because of absolute scarcity. While central banks can print unlimited dollars or rupees, Bitcoin has a hard code limit of exactly 21 million coins.
Then there's Ethereum. Think of Ethereum not just money, but as a giant global software platform that lets developers build decentralized financial applications using smart contracts.
But hear this, crypto is incredibly volatile. Driven by global liquidity and retail sentiment, assets can swing 20% in days. It is high reward, but extremely high risk. That volatility brings us directly to our fifth asset class, the ultimate double-edged sword. Derivatives, specifically futures and options, or F&O. A derivative is a financial contract that derives its value from an underlying asset, like a stock, index, or commodity. You aren't buying the asset itself, just a contract on its future price. The core superpower of F&O is leverage. You can control a massive position of shares with just a small fraction of the capital up front. This amplifies both your profits and your losses.